So now the quick quiz is that you need to distinguish between Rome at FS level and Rome at assertion level. I'm giving you two situations over here. The first situation is management bonus dependent on profit, and the second situation is the other situation is management bonus dependent on revenue. Right? And let's take a third situation as well. Inventory obsolescence. So you see, there are three situations. I've highlighted them for your ease. These are three situations, and we need to tell which of these situations is an example of a Rome at FS level and which of these is an example of a Rome at assertion level. The correct answer to this question is 1 and 2, that is management bonus dependent on profit and management bonus dependent on revenue. Both of these are examples of Rome at FS level. Why? Because multiple assertions are being affected. For example, in the first case, when management bonus is dependent on profit, you cannot exactly tell which component, whether management would inflate revenue, whether the management would understate cost, whether the management would understate administrative expenses, whether the management would understate selling and distribution expenses, whether the management would overstate its other income. You cannot tell anything. And then you can also not tell which assertion, for example, if management would inflate, whether the management would inaccurately state revenue, whether the management would record revenue that has not occurred, whether the management would misclassify revenue. You have no idea. So this is the Rome at FS level because there are multiple components of the financial statements that could be materially misstated, and which assertion the management would play around with, you're not clear on that. So that is why it is a Rome at FS level. For the second scenario, management bonus dependent on revenue. Again, this is the Rome at FS level because while you can spot the component of the financial statement, that is revenue, which will be materially misstated, but you cannot tell which of the many assertions pertaining to the revenue would be materially misstated. So because you cannot specify the specific assertion, because you cannot tell the specific assertion which would be materially misstated, so even if the management bonus is just dependent on one component of the financial statement, that is revenue, it would still be classified as a Rome at FS level. For inventory obsolescence, on the other hand, you can exactly tell that inventory would be overvalued. So the valuation assertion, you can specify that it is the valuation assertion which would be materially misstated. So because you can tell the specific component and the specific assertion that would be materially misstated, that is why this is Rome at the assertion level rather than Rome at FS level. There's a very good question that has came up from a student, that whether inherent risk or even for that matter controlled risk is controllable or not. Now the first thing is, who can control it? As far as the auditor is concerned, auditor cannot control either inherent risk or controlled risk. As far as the auditor is concerned, from the auditor's perspective, neither inherent risk is controllable nor control risk is controllable. Why? Because they're both prior to the audit, so the auditor cannot control them. Secondly, if you talk from the management's perspective, let me tell you from the management's perspective, inherent risk, to be honest, is not precisely controllable, because that is embedded in the characteristics of the transaction. If a transaction is complex, that's how it is. If a company is operating in a high-tech industry, in a fashion industry, that's a risk that it has to live with. So the point is, inherent risk is not exactly controllable, but as far as control risk is concerned, that can be controlled if company implements a sound system of internal controls, and if company makes sure that controls are operating very effectively, and if company's management and board has a very positive attitude towards controls, and they make sure that everyone adheres to the system of internal control, then in that case, yes, we would say that control risk can be reduced by the management by implementing a sound system of internal controls, but inherent risk is beyond the control of the management even. As far as the auditor is concerned, auditor can neither control inherent risk nor control risk, because that is a risk which is specific to the entity. That is a risk which is specific to the entity. Now, let's move on to the next theme. If you clear up till now, and that is the third type of risk which is examinable. So far we've covered what? We've covered the types of risk examinable in AAA: business risks, risk of material misstatement. Now let's understand the third category, and that is audit risk. What is audit risk? Audit risk is the risk of inappropriate audit opinion. The risk of inappropriate audit opinion when FSR MM, when FS is financial statements, MM is material misstatement. So audit risk is the risk that the auditor expresses an incorrect opinion while the financial statements are materially misstated. An example could be that there was a revenue expenditure. Now we all understand from our accounting knowledge of International Accounting Standard 16 PPE that revenue expenditure has to be expensed out in the profit or loss account. But the management has incorrectly capitalized that revenue expenditure as capital expenditure. And because that's a material amount, so financial statements are not free from material misstatement, because there is a material misstatement in the financial statements. But if the auditor, the risk is that the auditor somehow misses out this misstatement, does not take this misstatement into account, and gives an opinion that congratulations, everything's all right. Financial statements give a true and fair view. Go and rely on these financial statements for all your decision-making purposes. So this is what? This is an incorrect opinion, because financial statements do not give a true and fair view. They have not been prepared in all material respects in accordance with the applicable IFRS. So because they have not been prepared in accordance with applicable IFRS, you cannot say that the financial statements give a true and fair view, because they don't. So this risk of the auditor expressing an inappropriate opinion while the financial statements are materially misstated is termed as audit risk. The good news is audit risk is a function of ROM and DR, detection risk. So it means ROM is a subset of audit risk. So if it's a question, whether it's a question on audit risk or it's a question on ROM, what is common? ROM. The additional thing that you need to discuss in an audit risk question is detection risk. So audit risk, the risk that the auditor expresses an inappropriate opinion when financial statements are materially misstated could be either because the financial statements are materially misstated prior to audit, that is ROM, or due to detection risk. Now detection, while ROM is entity specific, client specific, and the auditor cannot control ROM. Auditor cannot alter ROM, but detection risk, I hope you would understand, is auditor specific. What is detection risk? It is the risk that audit procedures fail to detect material misstatement. auditor applied certain procedures, because auditor examines financial statements. So in examining those financial statements and testing the reliability of those financial statements, the auditor applied certain procedures, but the auditor failed to detect a material misstatement. Now that might be a little surprising for many of you, that if the auditor applied procedures, then why is it that the auditor could not detect a material misstatement? It's due to sampling risk and non-sampling risk. Sampling risk is that the auditor tests or examines transaction on a sample basis, on a test basis. Auditor does not examine 100% of the population. Rather, auditor only performs procedures on a sample basis, on a test basis. And that sample may not be representative of the target population. Resultantly, the auditor arrived at an incorrect conclusion. For example, the items that the auditor tested, they were all right. So the auditor said everything's all right. So the misstated items were not a part of the auditor's sample. Hence, the auditor could not get to know that, okay, there was a material mistake. Besides that, there's something known as non-sampling risk. Non-sampling risk has nothing to do with the sample size. It's just that you did not plan the audit properly. The team members were not experienced, or the client has entered into certain new businesses, new markets that you don't have appropriate experience of. The audit team was not properly supervised by the manager and the engagement partner, or the audit was time pressured, so appropriate time was not invested in concluding the audit. So in such scenarios, what will happen is that the auditor will fail to detect material misstatements. So the reason why auditor fails to detect material misstatements is either due to sampling risk, which is related to the sample size, or non-sampling risk, which is related to factors other than the sample size. Here's an exam focus point for you, and that is answers to audit risk and ROAM are exactly same except for DR that has to be discussed in audit risk question. So if you get a question on ROAM, or if you get a question on audit risk, 95% of the answer would be same. The only difference between audit risk and ROAM question is that audit risk besides ROAM would also require a discussion of some of the detection risks. Let's move forward. Now we move towards the most important portion of the lecture. Obviously, the other portion was also important. I mean, we weren't wasting time, but this is the super important portion. So please pay a lot of attention to make sure that you're appreciative of the themes. Exam focus. Common errors in answering business risk questions. So you're being told you will be taking exam in September. You're being told on 31st May what sort of mistakes candidates commit and that you don't have to commit. Common errors in answering business risks questions. Confusion between business risks and ROAM or audit risk. I told you even in yesterday's class. The examiner is asking you business risk, you're telling him ROAM. The examiner is asking you business risk, you're telling him audit risk. Please don't expect him to be lenient with you. You won't be given any credit. You won't be given any credit. Reproducing theoretical definitions. The probability of you being asked in AAA exam to define a business risk, to define an audit risk, to define ROAM is 0.00001%. So please tailor your answers to the specifics of the scenario. Do not reproduce definitions of business risk, audit risk, ROAM unless you've been specifically asked to do that. Because if you're giving those definitions, usually your questions are structured in a manner that you're writing an email to the partner. Now just imagine you're writing email to the partner and you're telling him that, well, maybe you're not informed enough, but I'm telling you, audit risk is the risk that the auditor expresses an inappropriate opinion when financial statements are materially misstated. And don't you think it would be a bit of a too much insult to the partner? I mean, you're telling the partner about what an audit risk is. I'm afraid the partner would not at all be interested in that. Talking about IFRS in business risks is fatal. I told you, I'm repeating, when it's a business risk question, forget about it that you're an auditor or you're attempting an audit exam. Think you're attempting an SPL exam, you're attempting a business analysis exam. So all you have to talk about is the business related risks from the management's perspective, from the business perspective, and not from the audit perspective, not from the auditing standards perspective, not from the IFRS perspective. Another very important issue is, like we were discussing in the orientation session as well, failure to develop the risks properly. You don't explain, candidates fail to explain the risks properly. What do we mean by developing risks? It means you need to identify the implications on the business, implications on various stakeholders. They're not described well. Not just describing well, but there's another issue, not assessed. This is a very important cause of concern. There are multiple risks in a case study scenario. Some risks would be more intense, would be more grave than other risks. So you need to, do some sort of a prioritization, and you need to tell, okay, this is the risk that is high because of this factor. For example, because all of your business is dependent on one customer or two customers. So if that customer goes bankrupt, that's a huge risk, because because of your dependency on a narrow range of customers. So where possible in an exam, do give an attempt to assessing the risk. That is, why is this particular risk, or why this particular risk should be a cause of great concern for the management. Financial, non-financial information not adequately used. Now, this is also a great cause of concern. You're given a lot of numbers as well, dollar numbers. So you should be working out ratios, you should be working out trends. If gross profit margin is declining, that should be a cause of concern for the business. If interest coverage ratio is going bad, is worsening, that will create troubles for the business in terms of meeting its debt covenants, and that could create troubles for the business in meeting its scheduled interest payments. Non-financial information, you're given data, for example, number of customer complaints are increasing. Don't you see that as a business risk? That is indeed a business. That means per customer relationship management, that means per customer satisfaction levels. And so that should be analyzed and that should be viewed as a risk. Linking every identified risk with going concern problems. Now, I don't know how to overcome this problem. For the last 8 years that I'm into lecturing this course, I've tried to explain this to students, but somewhat they keep on committing this mistake. So let me just give it another attempt. And that is the going concern troubles, the going concern problems. What happens is they identify a risk of a decrease in sales, for example, and they say, okay, fine, because company sales are decreasing, now the company will not be able to continue in operational existence. The company is going to die down. The company is going to go out of business. No, stop. Going concern is not that straightforward, or going concern troubles are not that straightforward. You need to see if it really warrants a going concern discussion. Now, I would be putting two situations in front of you. Situation one, a company is profitable and it has suffered a decline of 5% in its sales. On the other hand, a company is operating on a break-even level and it has suffered a 5% decline in sales. In the first situation, while profitability will be reduced, but there won't be going concern troubles. But in the second scenario, when the company is already operating at a break-even level, at a no profit, no loss level, so that company could potentially encounter going concern troubles because of the situation of decline in sales. So you need to see whether it is applicable in the particular scenario or not. We will be applying all these techniques when we will be attempting exam standard questions in our next class. But for the time being, you need to be aware of this. Okay, headings not used for each separate risk. Now, I can't overemphasize that. I kept on telling you in yesterday's class as well in the orientation session that you need to separate each risk through a separate heading. That not only adds to the clarity of your answer, but through this means you're also able to earn some of the professional marks. So you should be using headings for each separate risk. Okay, there's another mistake that candidates commit, and so I would want to draw your attention towards that mistake as well. And that is giving recommendations. I don't know the reason for this, but students start suggesting solutions to the management of the company that, okay, because they're facing this risk, they should be doing this. If they're facing, for example, foreign currency risk, or if they're facing interest rate risk, they should engage in interest rate hedging. They should engage in hedging and foreign currency risk management techniques. Wait a second. Read the question again. Were you asked to suggest risk management strategies? The answer is no. For the last 10, 20 attempts, you've never been asked to give your recommendations or to provide solutions or give recommendations on how to overcome risks. So if you have not been asked to do a particular task, all the time, all the writing time that you're spending, it's a waste of time. You won't be given any credit, no matter how good quality recommendations you're giving. Just imagine you've been hired by a client and you do something for them that they did not ask you to do. Do you really think they would be willing to pay for that service? When they would say, fair enough, you've done this for us, we never asked you to do it. So that's precisely the case in your exam. So what are the common errors in answering ROAM or audit risk questions? Let's see that as well. In ROAM or audit risk questions, you see, what is ROAM? Risk of material misstatement. Risk of material misstatement. So don't you think materiality levels should be calculated with respect to all applicable benchmarks? For example, profit before tax, total assets. This is something that's frequently omitted. And these are easy marks. I mean, excuse me, these are easy marks. Easy in the sense that it is so easy to calculate materiality levels. You just have to form a ratio comparison and you can arrive at materiality. But candidates frequently lose on these easy marks. Relevant IFRS requirements not mentioned. You see the word relevant. Now, if it's inventory valuation, the relevant principle is inventory must be valued at the lower of cost and net realizable value. That's the relevant principle over. Now, IS2 has got a lot of other principles. It talks about FIFO, it talks about weighted average cost method of inventory valuation. It defines what an inventory is, then it goes on to define what cost is, but that's not relevant. That's just not relevant. The only relevant principle is the valuation principle. So that's what you should be talking about. So it depends on the specifics of the scenario. You need to understand what is relevant, and that requirement needs to be explicitly spelled out in your answer. Another common error that students commit, they do not identify the specific components of financial statements prone to misstatement. They fail to identify the specific components. While for ROAM at FS level, you cannot identify the specific components, and the examiners totally appreciate that. But there are certain scenarios, specifically for ROAM at assertion level, you should be very comfortably able to identify which components of the financial statements will be materially misstated. For example, when we were discussing this, competitor launching a better product, we said inventory will be overstated potentially. Cost of sales would potentially be understated. So we identified the specific components of the financial statements that could be materially misstated. So you need to, in an exam, specify the components of financial statements. You also need to specify the direction of misstatement. You also need to specify the direction of misstatement, that is whether it is an overstatement or an understatement. Whether it is an overstatement or an understatement. You don't have to just say inventory would be misstated. That's not an answer. You have to specify what would be the direction of the misstatement. Besides that, you also need to keep in mind that misstatement is not just over and understatement. If a disclosure is inadequate, if a disclosure is omitted, that is also a material misstatement. So for example, if a material non-adjusting event has not been disclosed, a dividend was declared post year-end, that's a material non-adjusting event. It should be disclosed as per IS 10. The management has not disclosed it. So there's also a risk that the disclosure has been omitted. Sometimes the risk is less of an omission and more of an inadequacy. I mean, the disclosure is there in the accounts, the disclosure is there in the financial statements, but it's incomplete. For example, the management talked about the nature of the event, the non-adjusting event, but it did not talk about the financial impact of that non-adjusting event. So you cannot say that the disclosure has been omitted. I mean, the disclosure is there, it's incomplete, it's inadequate. So there's when it comes to disclosure, there are two risks that you're dealing with. One is the risk of omission of that disclosure altogether, and the other is that the disclosure is there, but it's incomplete or it's inadequate. ROM at FS level are not handled correctly many a times by students. If it's we've already discussed this earlier through the different examples. So I hope you will be able to handle it correctly now. Detection risks not identified in audit risk question. I mean, in an audit risk question, if the question is audit risk, be sure that there must be some discussion of some sort of detection risk, because obviously even in an audit risk question, your answer would predominantly revolve around ROM, but there has to be some discussion of detection risk, because that's precisely the difference between an audit risk and detection risk. ROM. Group audit risks are sometimes misunderstood. We will develop a better understanding of these once we move on to the exam standard questions. So if there are any ambiguities, if there are any confusions, please put up your questions via chat box or via your not just chat box, but you can also put up your questions through other mediums. You can raise your hands. Okay, let's connect in 2 minutes. Let's connect in 2 minutes.